Welcome everyone to another session on tax updates across GCC by Premier Bins Global. We are happy to welcome you all to this session. Let's wait for a couple of minutes before everyone logs in and then we can start the session.
Yeah.
So welcome everyone. So today we are going to talk about the tax updates in UAE, in GCC countries, including UAE, Bahrain, Saudi Arabia, and Oman. So first of all, I'll just give a quick introduction about myself, about speakers and the firm. So I'm Rishi Aggarwal. I'm a partner in assurance at Premier Brains Global. And Premier Brains Global, we are present in currently 4 countries, and we are serving a host of clients, including mid-sized to large corporates. Our host of services include assurance, taxation, advisory, and today we have got a line of speakers from UAE, Saudi Arabia, and Oman. So next slide, Harsha. Okay, just go back. Let's talk about our journey also quickly. So we were established in 2013. We had our first overseas office opened in 2019 in Kuwait, followed by 2020 in Oman. Then we had got offices in Abu Dhabi, Ajman, and finally we opened our last overseas office in Saudi Arabia in 2024, and much more to come, much more expected to come in the future years. Next slide, Harsha. So from UAE, we have got 2 speakers today. Our 2 prominent speakers are Mr. Vinit Kala and Ms. Harsha Jain. Vinit is director in tax and he is a chartered accountant by profession. And has a diploma in international taxation. He has overall more than 10 years of experience in corporate tax and VAT, international tax and transfer pricing. Before joining Premier Bains, he was associated with firms like Ernst& Young and Deloitte in the past years. So I welcome Vinit for being a speaker on direct taxation for UAE and Bahrain today. Along with Vinit, we have Harsha. Harsha is a chartered accountant by profession and having more than 10 years of experience in taxation and she has served in various countries including UAE, India, Malaysia, and other GCC countries. And she has worked in various sectors, including banking, life science, logistics, insurance, broking, manufacturing, and real estate. Harsha will be speaking today on the indirect taxation part for UAE and Bahrain. So I welcome both of you to start the session for UAE at the first. So Vineet.
Yeah, thank you, Rishi, for the kind introduction. And once again, a warm welcome to each and everyone present in the webinar. Thank you for your time. Starting first is, of course, the UAE, where we have seen corporate tax law getting evolved. Of course, the corporate tax law was announced in early 2022, and we were waiting for the decree law to come in. But the decree law had been published in the public domain in December 2022, and then it was only a 70 pages odd paper. And then we were waiting for many clarifications in the form of cabinet decisions, ministerial decisions, and FTA decisions to come out. 2023 did see plethora of cabinet decisions, ministerial decisions, and FTA decisions coming in, which makes the law mammoth and, of course, more relevant in the context of the industry, because many issues were not addressed in the decree law, but they were then clarified and additional guidance were provided. Following the ministerial decisions, cabinet decisions, and FTA decisions, we had plethora of guidance also coming in from the FTA, which clarified more on the burning topics. And then, of course, we did have the Pillar 2 regime, which is the last major announcement as far as UAE corporate tax is concerned. The Pillar 2 regime applies from FY25 and onwards. Of course, there are some thresholds. Not everybody would be covered under the Pillar 2 regime. And the detailed guidance was out in late 2024. The agenda for today is the updates for the UAE corporate tax law. So on the screen, we have just tried to capture whichever updates are there available in 2025 till date. Of course, when the amendments are there or when clarifications are provided, these are provided through a cabinet decision, ministerial decisions, guidance, and FTA decisions. So we have actually four decisions, rather five. The fifth one was the latest, which came in last week. But let's focus on the four which are there on the screen. Cabinet decision 34 and 35. Now, 34 are dealt with the qualifying investment funds and limited partnerships. When the law was published, we very well know there are exemptions available to a qualified investment funds, which includes the real estate investment funds. And there was a separate cabinet decision which gave the more conditions for availing those exemptions. But as the time passed, I believe government might have realized some changes were required, and then they revoked those decisions. And then a fresh decision has come out in the form of decision number 34 of 2025, which refines the conditions. Couple of conditions were withdrawn, couple of conditions came in new, and now I believe it is structured in a way which favors the industry. Net, I would say natural persons who are actually the investors in the qualifying funds, be it real estate funds or investment funds at large, they are out of scope of taxation, and the fund itself has the exemption available, of course, with some kind of conditions attached to it. But interestingly, we also see some kind of a negative list in the condition itself, wherein if you violate, then some amount of income becomes taxable, and primarily the taxation impact is passed on to the investors. Now, as I mentioned, the natural persons are out of scope as far as they are the investors. But when it comes to a juridical person, be it a resident juridical person or a foreign juridical person, taxation impact is there. Primarily, if you violate some of the conditions or you are under the negative list. We are not getting into the technicalities in this webinar, but yes, for the benefit of the larger audience, in case you are a qualifying investment funds or you are an investor in a qualifying investment funds, of course, the conditions need to be reevaluated now and seen whether any taxation impact is there as far as the return filing and registration requirements are concerned. And the connected decision to this decision is decision number 35 of 2025. It dealt with Nexus, and yes, as we see, we did have Nexus rule being defined by a previous decision, which is now getting revoked and replaced by decision number 34. But yes, to have a fact in place, the decision is a welcome decision where it clarifies that the individuals who are there are not in scope as far as residents are concerned. Just a second. But yes, when you are a juridical person and some interest is there for the UAE real estate property, then some kind of taxation would be there covered under that decision. Next is the decision number 55, wherein it expands the scope of exemption available to certain persons. When you see the decree law, there were categories of person, and qualifying investment funds was one of the persons which had an exemption in place. But I believe the government would have thought and some representation would have been made to the government where the same exempt person is actually owning another juridical person which is not incorporated in UAE but in a foreign juridical person. But broadly, all the conditions have been satisfied. So government might have thought, okay, we should extend the same exemption to that foreign juridical person as well. So decision number 55 dealt with a foreign juridical person, which is actually owned by the exempt person, to have the exemption in place, of course, by meeting certain conditions which are prescribed therein. We are not getting into the nitty-gritties of the conditions, but yes, in case you have always had an exemption in place and you have another investment, maybe by way of a subsidiary, which is incorporated outside UAE and effectively it is managed within UAE, then yes, you need to reevaluate your structure and see whether the exemption can be applied for such foreign juridical person as well. And then last is decision number 63 of 2025, which deals with unincorporated partnerships. This is the latest amendment wherein we have seen a FTA decision also coming in for the unincorporated partnership. But this decision specifically deals with the opaque structure wherein you voluntarily, as a partner of an unincorporated partnership firm, approach the FTA and say, okay, I want my unincorporated partnership to be treated as a juridical person and avail a normal taxation regime the way other LLCs or other free zone establishments are having. So broadly, decision number 63 deals with unincorporated partnership, which voluntarily wants to be treated as a juridical person and have a opaque structure in place. Next, we talk about the ministerial decision. We spend more time on ministerial decision 84 of 2025, which is relevant to a larger audience in UAE. It deals with the audit of the financial statements. Of course, the way we saw in cabinet decision, the previous decision was already available. But yes, we see some fine tuning of a language or the interpretation or some clarification in the new decision which has come in. So it broadly deals with three categories, or rather four categories. First being a qualifying free zone person meeting all the conditions, the audit is compulsory, which the decision clarifies. Second, in case you are not a qualifying free zone person, but your revenue is more than 50 million, then audit becomes compulsory for the corporate tax law. Third category specifically dealt now, which was not dealt previously directly, which is about a tax group. Now, the wordings of the law was such that definitely when you are forming a tax group, a special purpose consolidation was required. But since it was not mentioned directly in any decision, indirectly in the law, but not directly in any of the decisions, there was some ambiguity. And of course, I believe some people might have reached out to FTA by way of private clarification or a representation to have a clarification in place in public domain for an audience at large. So now this decision specifically says when you are a tax group, a special purpose consolidation would be required, and the prescribed rules around the special purpose consolidation is still awaited. And the last category, which deals with the financial audit or the audited financial statements, would be for the case of non-resident having a permanent establishment in UAE. So the decision clarifies that revenue threshold would only be counted of the permanent establishment and not that of the headquarter. So if you have a permanent establishment here in UAE, so the revenue of only the permanent establishment would be counted for the threshold of 50 million and not the entity which includes the headquarter as well. So these are all the four welcome clarifications from the FTA, which we see from decision number 84 of 2025. And then, of course, we have decision number 96 of 2025, which gives a condition for the real estate investment trust. Ideally, it deals with the listing of the shares on the stock exchanges. So it gives a threshold what proportion should be listed for availing the conditions of exemptions for a real estate investment trust. Again, a bit technical, and in case you have a structure in place for REITs, then definitely we are open to discuss that. Otherwise, it becomes more of a theoretical for the timing. And then last, we had a corporate tax guide coming in, giving us more clarity on the interpretation. First guide was on the interest limitation rules, where they have dealt every aspect of the interest component of various financial instruments, etc., with the examples. And then recent family foundations, where they have given the further guidance. Of course, the law is evolving as far as family foundations are concerned. We did see the application was not opened for the entire 2024. They opened in early 2025, wherein we have also approached our clients and we have made an applications for treating family foundations as a pass-through or an unincorporated partnership. And of course, the approvals are still awaited. So the law around family foundations are still evolving. And with time to comes, we are confident UAE government would be coming in a very favorable environment for the family foundations. So net around the corporate taxes, these were the recent amendments in 2025. And the important point to note is, except for decision number 55, Cabinet Decision 55 of 2025, along with 63 of 2025, all the other decisions are prospective in nature. And only 55 of 2025 and 63, they have been given a retrospective effect. So in case you're looking for applying those decisions which are prospective in nature, they will apply from FY25 and onwards. So for FY24, you apply the previous decision was which was there in public domain. So that's it, net from the UAE corporate tax side. I hand over to Harsha for the VAT updates.
Thank you, Vinit. Good morning and welcome everyone. With CAT being the new kid on the block, we would expect FTA to slow down a little in the VAT, but we definitely do not see that happening. We see clarifications and amendments keep coming in. We see a lot of changes in the VAT law as well. And today we are going to cover the major amendments that have come in 2025 so far. The first clarification we are going to talk about is on the concerned services. So just to give a brief about what concerned services are, suppose there is a UAE VAT registered business who receives legal consultancy services, let's say from a Hong Kong based vendor. If these services were procured locally, they would have been taxable supplies. These services, when procured, basically any taxable services, when procured by a UAE VAT registered person from a vendor based outside UAE, are called as concerned services or import of services. Now, the requirements that come in when you are importing services are, there are three requirements. First is you need to treat these supplies as if you are making the supplies to yourself. So you need to account for output VAT at the applicable rate and pay to FTA. Report it in the return actually. Then also you need to issue a tax invoice to yourself, considering that you are the one making supplies to yourself. Thirdly, you can claim the input tax subject to you have the sufficient documentation like the vendor invoice. Now, the requirement regarding issuing of tax invoice to yourself, FTA has addressed this requirement in this clarification and has done away with it as long as you retain the vendor invoice. So basically, in our example, the UAE-based businessman can claim input tax on the basis of this legal services as long as he has the vendor invoice, and he need not issue any self-invoice to himself as long as the documentation is maintained. The next clarification that has come in is more of an extension to the previous clarification, but it is more relevant to financial sector like banks or exchange houses. On a global level, international transfer of funds is actually executed by way of SWIFT messages. So suppose there is a UAE-based bank that is transferring funds to an India-based bank, then that is done through SWIFT messages, and the bank or the SWIFT, which is a society, charges this UAE-based bank some charges, bank charges. Again, this becomes a service provided by a non-UAE based vendor to a UAE based VAT registered business. So there is a requirement to account for RCM in this case and issue the self invoice. But FTA has clarified that given that the volume of transactions is huge, banks and financial houses enter into these transactions at a large volume. So FTA said there is no need to issue a self-invoice to yourself as long as you maintain the SWIFT messages, and that acts as documentation for claim of input tax. But one thing to note is that the SWIFT messages should contain essential information like the provider's detail, recipient details, your currency in which the transaction has happened. So this is also a relief to financial sector. The next clarification that we're going to talk about is the barter transaction. It is a simple classic case of one person has wheat, another person has rice. Instead of giving money to each other, they simply exchange those things. So that is what a barter transaction is. One of the major consideration in a barter transaction is that there will always be minimum of two supplies, and they both have to be treated as supplies by the two parties involved. Now, since there are two taxable supplies, at whatever rate applies, there is a requirement to issue a tax invoice as well by both the parties. Now, one important point that comes in this scenario is how do you value the non-monetary consideration that you're receiving? So with this clarification, FTA has clarified that the how the value for the non-monetary consideration will be the market value of the non-monetary part. Suppose the exchange was happening for 5 kg of wheat for, let's say, 2 kg of rice. Then you take 5 kg, the value of market value of the 5 kg of wheat. This appears very easy to say, but practically when you apply it and market value is taken, that the market value of the two transactions might not really come equal. So while executing this transaction practically, we might have to do some adjustment in terms of taxable values, given arriving at the taxable value might be difficult. In case you do not have a similar, you don't have a comparable wherein you can find a market value, replacement cost can also be considered. But this appears simple, easy said, but practically it might be a bit difficult to apply that. How do you actually arrive at the values in a barter transaction? The next clarification is actually also an amendment. As you would know that in case of supply of gold, earlier the case was that if the gold, if it was not subject to zero rate and it was being sold to a VAT registered person for further reselling, that was subject to RCM and there was no need to account for VAT by the supplier. So this case of reverse charge mechanism has been extended to precious metals and stones as well. What gets covered under precious metals and stone is metals covered gold, silver, platinum, and palladium. Stones covered diamonds, pearls, rubies, sapphires, and emeralds. But again, the conditions remain the same. The recipient must be a VAT registered person, and also the recipient must be procuring the goods, these jewels, for the purpose of reselling or probably putting it into manufacture of further reselling. So it should not be for retail sale. If we are going to a jewelry shop and buying it for a personal use, then this does not apply, and we will have a VAT charge on the invoice. Now, one important thing to note, as we see very often in case of jewelry, are the making charges. If the vendor is, if the supplier is selling the goods in such a way that he considered making charges as part of the goods that is sold, suppose you buy the jewelry for value of 50,000 dirhams and he says it is inclusive of making charges, then the whole jewelry becomes subject to RCM and there is no need for separate treatment of making charges. But in the same example, if he says that jewelry is worth 50,000 and they're charging 5,000 worth of making charges on this, then although the value of 50,000 gets covered under RCM, the supplier still needs to charge VAT of 5% on the making charges that he's applying. So this is more of an extension of RCM to precious metals and stones. These are the recent clarifications that have come in UAE VAT. We also have a clarification on the executive regulation, but we already covered the executive regulation in the previous webinar. So we are not getting into details on that clarification in this. Moving on to the updates that have come in Bahrain. So the first clarification that has come in Bahrain is in relation to export. We already had clarity on this in UAE. This is more from a term of indirect export. So authorities have clarified that in case of indirect export, it should not be the case that a supply is being made prior to export. So basically, it should not be a bill to ship to transaction. It should be an indirect export. Then only the transaction will be 0%. In case the situation is that there are two transactions that are taking place in this in a case of export, then only one transaction can be subject to 0%. You cannot call both the transactions are subject to 0%. Another amendment that we have seen happening is in terms of real estate. In the state of Bahrain, generally supply, that is sale, lease, license of real estate, be it commercial or residential, is exempt in nature. But with effect from 1st January 25, NBR has clarified that in case there is a provision of space for retail or promotional stands like kiosks, small kiosks, they will not be treated as exempt supplies and will be subject to VAT. However, if the kiosk is of a nature of a permanent shop, then the exemption still continue to apply. Moving forward, we see e-invoicing is the buzzword going around in the whole GCC region, and Bahrain is no less. We see that after introduction of e-invoicing in KSA, even Bahrain is planning to implement that in a phased manner. We expect that there might be some announcement around it by the end of year 2025 or by the beginning of 2026. These were the updates that have come in VAT, recent updates in VAT for UAE and Bahrain. I would request Vinit to please take up the CT updates.
Yeah, thank you, Harsha, for the updates on the VAT side. Coming to Bahrain, Bahrain, as we understand, for time being, it is not a full jurisdiction which is covered for the corporate taxes. But definitely, once the Pillar 2 rules were announced at a global level, Bahrain has been part of the inclusive framework. And thus, Bahrain too included its Pillar 2 regime by way of a separate decree, which is Decree Law number 11 of 2024. So now, as far as Bahrain headquartered MNCs are concerned, or the larger corporations are concerned, which are meeting the prescribed thresholds, they are under the net of the Pillar 2 regime. So they are required to register themselves under the Pillar 2 regime under the Decree Law 11, and there would be some reporting requirements as well. But one point important to note over here is, which we do see the queries coming in from the clients as well, be it UAE, Bahrain, KSA, or any other region. The query is how the Pillar 2 mechanism works. So to clarify, in the interest of the audience, Pillar 2 regime, or I would say the global minimum tax regime, is a parallel regime which will run with the corporate tax law of the respective country. So let's take an example of UAE, because UAE also has aligned itself with the Pillar 2. And of course, from 2025, some of organizations would be covered there. So there would be a corporate tax calculation running, and parallel calculation would be running in for the Pillar 2 calculations, which net brings in tax of 15%. Though 15% would not be a top line, because it's a differential tax. So in case your domestic taxation is not up to 15%, then automatically by way of a calculation under the Pillar 2 parallel regime, your taxes which would be payable to a respective government, in my example to a UAE government, would be cooped up to 15%. When we do the calculation, it may not be 15% exact because there are some safe harbors, etc., being applied there. So there could be a case the overall tax liability maybe 12%, maybe 13%, maybe 10%, or it could be 15% as the case may be. So that was it from the Pillar 2 regime. Bahrain, net, no corporate tax regime, but for few MNCs, the Pillar 2 regime continues now. Yeah, over to you, Rishi.
Thank you, Vinit and Harsha, for the insights on UAE and Bahrain. We came to know very good about the Qualified Investment Fund and the limited partnerships new updates on the 84-25 for the audit of non-residents, then on the barter transactions and the precious transactions. So there are a lot of updates which were very insightful and useful. Now we have the pleasure of introducing CA Sanjay Tiwari for Oman tax updates. He is a chartered accountant with over 36 years of experience, specializing in management, financial, corporate governance, and taxation. He has held leadership roles, including CFO, and acted as a CEO also of few organizations, and has done a lot of mergers and acquisitions and ERP implementation transactions in the past. So I welcome Mr. Sanjay Tiwari to have updates on the Oman. Thank you.
Thank you, Rishi. Thank you very much. And good morning all from Muscat, Oman. Now, I will be talking about this recent changes which have been taken place in 2025 in Oman. And I'll begin with the VAT, where we are looking into this e-invoicing rollout, which is initiated by Oman Tax Authority. And we are looking for this phased implementation that's going to be, adopted by the government authorities. So they are having pilot phase is there starting from Q3 to Q4, and where is voluntary onboarding for 100 plus large experts for pilot implementation. Then phase 1 will be there, where Q1 to Q2 and 27, and there will be registered entities will be required to adopt the e-invoicing, and phase 2 mandatory for all will be Q3 Q4, and where SMEs, B2B, B2C, and G2B government to business invoicing included. And the last phase will be 3, which is Q1 to Q2 2028, where government to business taxpayers are covered here, invoicing becomes mandatory for everyone. So that's the invoicing rollout. That plan has come up. And the tax rate has been, the defined like standard is 15% for corporate tax. And there is a one reduced tax break of 3%, which is only applied to the Omani-owned SMEs and the company which has got 100,000 or less income and has got the less 15 employees and do not operate in banking, finance, and insurance sector. And other than this 3% subsidized rate, the standard rate will apply to all local and Omani companies, foreign entities with permanent establishment, and branches of foreign companies. There are some exemptions which are subject to certain conditions, which will be applied to the entity registered under special economic zones and the free zones. Yeah, next. Yeah, so thus basically the corporate export we are looking into it as the new law has come up with the new decree has come up with this SCJ and free zone law, and the main aspects which they are covering up is 10-year tax holidays, which is renewable by twice after fulfilling certain conditions, and this applies to zones, special zones like Dukum, Sohar, and Salala. So out of any entity which has been registered under these zones will be for them this new law will be applicable. Now this will also exclude the banking, insurance, and telecom sectors because they are dealt separately and they are not part of the regular regulations over here. And a detailed regulation is expected somewhere in the next quarter or maybe by April 2026 maximum. That's the time given by the decree. Yes, sir. Next, please. Okay, so withholding tax, as we are aware, the Oman has got implemented withholding tax for last few years. So now there have been some changes in withholding tax, and they have started applying, reduction of reduced rate of withholding. Withholding tax usually is 10%, but with the countries which has got the DTT, the withholding tax has gone down, and this includes Cyprus, Tanzania, India, and Ireland. Now, this has been made applicable from the May 25 and June 26, depending upon the DTT's applicability. Now, the one condition which is addition over there is that the person who's been claiming the reduced rate of entitlement for the reduced rate of withholding tax has to submit their tax residence certificate in Oman to submit their claim benefit, which means basically like somebody from India is trying to supply some services over here and there is a withholding tax on that. And the entity over here wants to reduce from 10% to 3%. The supplier has to submit a tax residence certificate of India to the Oman authorities, to the OTA, Oman tax authorities, for claiming this reduced rate of withholding tax. Yeah, next. Harsha, yeah. Yeah, okay. So thank you. That's the small updates over here in Oman. And over to you, Rishi.
Yeah, thank you for the updates on Oman. So updates on withholding tax updates, e-invoicing, those were quite insightful. And now I welcome our next speaker, Mohammed Abdelhadi from Saudi Arabia, who will update us on the tax updates in Saudi. So a brief introduction about Mohammed. He is a chartered accountant and a diploma holder in international tax. He has 13 years of work experience in corporate tax and VAT, international tax and transfer pricing. He has been a tax auditor and Egyptian tax authority, and now he's practicing in Saudi with us. So I welcome Mohammed Abdali to take up the session now. Over to you, Mohammed.
Thank you, Mr. Rishi. First of all, let me welcome my colleague, Zakat and Tax Specialist. Now let's take a look at the updates to Zakat and tax legalization in KSA. I will divide these updates into the following: updates related to direct taxes and updates related to indirect taxes. Regarding to updates related to direct taxes, I would like to draw your attention, my college. The direct taxes within KSA includes zakat, which applies to Saudi and Gulf nationals at the rate of 2.5%. Income tax, which applies to non-Saudi at the rate of 20%. Recently, Ministerial Resolutions number 1007 was issued regarding to the new regulations of zakat, which applied for the period beginning on 2024. Now, let's take a look at the most important features of this regulation. Feature number one, more details and analyzed article and provisions. The number of articles of this of new regulations is 128, and compared with previous regulations, only 33 articles. This meaning in the new regulations, this is more details and more analysis and more cases from ZATCA. Also, the second point in the resolution will provided for some previous dispute items. Feature number three, classifications of financial position items for zakat purpose. Also, regarding to feature number four, adoption of financial statement ending balance in contracting the zakat base. The new component of provisions during the year has become a deductible expense. There is addition on new deduction items in zakat base, such as governmental receivable. Next feature, it's setting an upper limit for zakat base, and there is a new concept that introducing of new production on new regulations that regarding to zakat perceptions. We are working to preparing an interactive workshop to more explain how to calculate the zakat base and filing the return according to the provision of new regulations. Now let's move to the next point of the updates related to direct tax within KSA. This is the fundamental update regarding to subjection of zakat buyers to the provision of the transfer pricing regulation that applied in KSA for period beginning 2018. This regulation previously applied only income tax payers. The Board of Direction of Zakat and Tax and Custom Authority issued the decision regarding to subjection to the zakat buyers to the provision of the transfer pricing regulation as follows. Phase 1, if the value of transaction with related party is 100 millions or more, zakat buyers now obligate to maintain transfer pricing documentation starting from 1st of January 2024, which this documentation including the local file and master file and certificate from CBA and the country by country report if required. And regarding to if in the case the transaction with the related party is 48 millions or more, maintaining of transfer pricing documentation starting from January 2024 is optional. The second phase will be after 3 years, starting from 1 January 2027. Inshallah, if the value of transaction with related parties is 48 millions and more, maintaining of transfer pricing documentation will become mandatory. Now we will move into the final point in the update regarding to related to direct tax, which is amendment related to the provision of article number 86, article number 68 in the income tax law. This related to withholding tax. The withholding tax rate has become 5%, which was imposed 15% on technical and consulting services between related parties. This is all update regarding to indirect tax. Now we will move into second part of our updates regarding to indirect tax. The indirect tax in Saudi, the updates related to indirect tax will be related to VAT and real estate transaction tax. Update related to VAT. Last April, ZATCA published amendment to the VAT regulation in the official gazette, which include a substantial changes. Let's comment on the most important ones as follow. There is the changes in article number 14. This related to clarifications of on services subject to VAT. As per this amendment, In the article number 14, there is a new paragraph added by amendment added by ZATCA that provide more clarity to services subject to VAT, such as grant rights and providing a facility or features. Also, there is in article number 15, there is amendment related to nominal supplies provisions. We will, inshallah, in the future, we will make a separate workshop regarding to every type of taxes, direct tax or indirect tax. Now we will only quick review on the all updates. Article number 17, there is update, which this is the article related to transfer of economic activity conditions to be out of scope of VAT law. There is also article number 47, which related to person obligated to pay VAT in special case, such as facilitating the supply of e-service through online marketplace. Now, there is important thing regarding to indirect tax updates. This is related to real estate transaction taxes. Regarding to the real estate transaction taxes, let us first define it is an indirect tax at the rate of 5% of the transaction value and applies to property disposal cases. And the person disposing of property is obligated to pay it. The real estate transaction tax was issued by Royal Decree number M84, dated on 22 September 2024. And let us now look at the most important provision of the law and its executive regulations, which related to exemption cases of the real estate transaction tax as follows. In the case of the real estate transaction without any considerations, but is related to legally licensed charitable association engaged in public interest. In this case, this is exempted from real estate transfer tax. Also, real estate transaction resulting from merger, there is some condition to be exempted from real estate tax. And also there is real estate transaction carried out in implementation of a forced sales order issued by competent court. This is also exempted from real estate tax. Real estate tax resulting from acquisition, also there is some condition to be exempted from real estate tax. This is all updates, and I will to my colleagues to draw your attention regarding to amnesty of exemption of penalty. The deadline will be the deadline will be 30 June next 30 June. This is to be any entity want to get the benefits of this amnesty. No time, only around 20 to 12 days to be get the benefits of this amnesty. Okay, Mr. Rishi.
Yeah. Thank you, Mohammed, for the insights and the new updates on zakat, transfer pricing, withholding tax, and VAT. It was very interesting to know about the new REIT law. Probably we should have a separate session on the RETT law, and that could be very useful for the audience. Now I will open the floor for Q&As. So you are free to ask questions in the chat box regarding the Q&As which you have. A few of them are already questions are already posted there, and I would like to address these questions to the speakers. So first question is for Harsha. The question is regarding, can we claim input VAT on fees charged by exchange houses such as ADX previously on dividend distribution fees for the distribution of dividend?
per se, dividend income is not taxable. So ideally, we should not be claiming that input tax because it primarily relates to exempt supplies. But we might have to look at the exact nature of expense that we have incurred. Most likely, it should not be recoverable, but we need to look into the details.
Okay, thanks for your response, Harsha. Probably Akshita, you can get in touch with Harsha after the session. The next question is I have a question regarding Oman withholding tax. So this question is from Abdul Wahab for Oman withholding tax. You can get in touch with Mr. Sanjay Tiwari after the session, or you can type the question here. The next question is
Yeah, I think Abdul Wahab is typing some questions. Abdul Wahab has typed some questions.
Yes.
We are a UAE-based company, and yeah.
Yeah, the next question is regarding a UAE-based company having our client in Oman, and the question is that they are raising invoicing to the client in Oman and they are deducting 10% withholding tax. So they have got a tax residence certificate as well in UAE. So would this be adjustable? This question is to Sanjay Tiwari.
Yeah, thank you, Abdul. Thank you for asking this question. This is a very pertinent and regularly asked questions to me from UAE entities, because a lot of suppliers from UAE are supplying goods and services to Oman entities, and the WST is being charged onto them. Now, the issue is there has to be a double taxation avoidance treaty with the two countries. Now, so far, there is no double taxation avoidance treaty with UAE and between UAE and Oman, and Saudi and Oman for the matter of fact. And that's the reason this WST cannot be adjusted against this, your tax dues. So that's the unfortunate part. But we are waiting for some more treaties are under consideration by the government authorities, and I think very soon we'll come up with the double taxation avoidance treaty with the other GCC countries. Once that happens, then yes, this will be applicable. But right now, it is not.
Yeah. So another question is from Mr. Ram Hulani regarding the withholding taxes for Oman. So the question is regarding the cross charges of allocation of marketing expenses and staff cost which are paid to Oman. And the question is that does it qualify for 3%?
Can we share more WST Oman payment related party for cross charge of allocation marketing? No, this is cross charge of allocation of marketing expenses, which means basically if you are raising if you are raising some invoicing and that's being paid by them, the WST will not be 3% just for the sake of because it's local. It has to be within the DTT countries. So within the countries like Cyprus, India, and so far there are only 3-4 countries which has been there. So if one of these countries you are resident of this, tax resident of that, and you have the certificate, then yes, with the tax resident certificate you can claim 3% WST. But if it is not within these 4 countries so far, and until the other countries are being specified, there is no exemption. You have to pay 10% WST on that as well. Okay. And you cannot claim also. Yeah.
Fine. Thank you for that. The next question is from Mohammed Abdelhadi. So the question is regarding the withholding tax. The question is whether they can claim the 5% withholding tax limit for payments to Saudi Arabia from UAE. This is from again Mr. Ram Hulani.
Again, please, Mr. Rishi.
Yeah, the question is that if there are cross charges or allocations of marketing expenses or staff costs, does it qualify for 5% in Saudi Arabia?
Yes. This is well subject to 5%, but maybe if he meets the condition of our double taxation treaty, if he want to apply the double taxation treaty, he have to get the benefits of this treaty between KSA and UAE to make elimination for this 5%. But the first, he will his customers will deduct the 5% on this transaction. After that, he will apply to the refund the 5% according to the double taxation treaty.
Okay. I hope this answers your question. Now, the next question is from Christine, and the question is regarding the Saudi tax amnesty program. Well, the question is whether there will be an extension after 30th June 2025 to Mohammed.
Sorry? Sorry, Mr.
Mohammed, the
Rishi.
question is that will there be an extension of Saudi tax amnesty program post
Y-
30th June
We
25?
Yes, up to now, no any news coming from ZATCA, but inshallah, we hope ZATCA issues a decree to make extend for this amnesty, inshallah. Maybe this is news will appear in the last of June, inshallah.
Yeah, thank you for that. The next question is for Sanjay Tiwari. The question is that if the client in Oman is also issuing a withholding tax certificate, will this be adjustable in UAE against the corporate tax?
As I already clarified, if there's a DTTA, Double Taxation Avoidance Treaty with the UAE, then it will be applicable. We can close it. But I can see they mentioned that some bank has told them this adjustable against this corporate tax, which we'll have to further inquire, and we need to go into the nitty-gritty of the. And they might, send us the specific case, and we can inquire about it and find out and advise them accordingly. But
Oh,
currently, generally, it is not. Yeah.
okay. So another one question is from Ankita regarding the claiming of foreign tax credit in UAE subject to extent of UAE corporate tax applicable on that income. If taxable, it should be limited to 9%. So this question is from Vinit from Ankita regarding the claiming of foreign tax credits in UAE.
Okay, yeah. So definitely foreign tax credit would be available. But the point or the important and the most important point to note here is the calculation is not that straightforward. Theoretically, yes, up to 9% you can claim, but we need to see how much the UAE taxes have been paid on that foreign sourced income. So in case your income is coming from Saudi Arabia and it has suffered withholding tax of 15% for that matter, the same income would be taxable in UAE at 9% without any doubt. But of course, there will be revenue, there will be a cost, and then there will be the net profit. So the effective taxation on that particular revenue streams will have to be looked into, and your foreign tax credit will be restricted to the effective rate of taxation or whatever withholding you have paid in Saudi Arabia, the lower of the two. So yes, theoretically, foreign tax credit is available. However, we need to have a detailed calculation in place for the foreign sourced income. How much is the effective rate of taxation paid in UAE? And then we calculate the foreign tax credit.
Thank you, Vinit. Vinit, another question for you from Mr. Ahmed Mahir. Question is that when free zone companies become disqualified from qualified 0% tax in UAE?
Okay, so I believe this was not the agenda for today, but let me answer it. There are a few conditions like the substance is not present in the free zone, then there is a disqualification. You are not dealing with your related party at arm's length, then there is a disqualification. You are not having an audited accounts, then there is a disqualification. And largely, if you do not have any qualifying income, then there's a disqualification. Free zone itself is a very large topic. If we take a webinar on that, even 4 hours is not enough today, as the law has evolved over a period of time. So in case you have further queries, then we can take it up separately post this webinar.
Sure. So we are running short of time now. So next question is for Harsha from Mr. Abdul Wahab. The question is that if a free zone company invoice to a company, mainland company, is VAT applicable on that?
So free zone concept works differently for VAT. First, you need to find out if free zone it's actually free zone or a designated zone. If it's a normal free zone which is not a designated zone, then no special rules apply. That again, it's a detailed concept. I'll have to answer in like really summarized way, but there is no straightforward answer. For services, designated zone are same as mainland, and there is no differential treatment. But if designated zone is selling goods, we need to check where the ownership is transferring. If the ownership transferred within DZ and the purpose is not consumption, then only the supply becomes out of scope, that too for goods. Otherwise, it's a taxable transaction. But designated zone is again a detailed concept that can take a whole 30-40 minutes.
Thank you for that. So another question for you, Harsha, that is director fees required to charge VAT on that?
Director's fee, earlier sitting director fee was never chargeable to VAT because it is treated as an employment contract. Earlier, non-sitting director fee was chargeable to VAT, but I believe there was a amendment in that and it stopped became taxable and it became out of scope later.
Okay. Thank you for that. So, Mr. Khalil has also asked another question, that is director fees subject to corporate tax for Vinit?
Okay, I was expecting this question to come up maybe by someone. Okay, let me answer it. Director fees, we need to see under what arrangement it has been paid and paid by the company and received by the individual. Usually, the director fee, by whatever name you call, managerial remuneration, director fee, or director salary, etc., if it is under a salary contract or an employment contract, then definitely it is out of scope. But in case it has a color of a freelancer, that there is only a peer-to-peer agreement for a management fee, which you call it as a director fee, then we need to see the nitty-gritties. And in case the remuneration is above 1 million, then there could be a requirement to register for the corporate taxes. And once you're registered for the corporate taxes, then we see the availability of a small business relief, if at all applicable, because small business relief is applicable if your revenues do not exceed 3 million. So net, if it is under an employment contract or an employment arrangement, then out of scope. If not, then definitely a registration requirement might trigger in, and then the consequences and the compliance requirement flow in.
Okay. Thank you, Vinit, for answering the question. Now, I would thank all the speakers, Harsha, Vinit, Mr. Sanjay, Mohammed, for giving us insights on the latest updates on taxation in GCC. And I would like to close this session with a vote of thanks to all the people who have been patient and listened to the updates and participated in the Q&A session. Looking forward to more such updates from our wonderful speakers, and looking forward to have another session on that one. With this, I close the session. Thank you very much for attending today's session. Thank you.
Thank you, guys.
Thank you.
Thank
Thank
you.
you.
Yeah,
Thank you.
thank
Bye.
you.